Welcome, Investment Committee, to today's Explainer. I'm stepping into the role of your senior value investor today, and well, we're going to try something a bit crazy. We are going to apply Warren Buffett's legendary, ultra-rigorous analytical framework to what is arguably the most speculative, high-growth sector on the market right now, the space economy. We're going to assess business quality, hunt for economic moats, and run a strict quantitative valuation on 3 major U.S.-listed space companies. And here's the kicker. We are doing this using strictly the provided financial documents, SEC filings, and recent market data. No hype, just the numbers. So grab your notepads, because we're bringing terrestrial value investing to the final frontier.
Okay, let's dive into this. Here's our roadmap for today. First, the space stock catalyst. Then, our business and moat comparison. Third, a deep financial data comparison. Fourth, valuation and safety margin. And finally, our final value investor verdict.
Section 1. The Space Stock Catalyst. Look, the entire space sector is about to be violently repriced. According to our sources, SpaceX is closing in on a massive $1.75 trillion IPO. Think about that number for a second. When SpaceX's S-1 document becomes public and we finally see Starlink's true subscriber economics and launch costs, it's going to instantly become the absolute financial yardstick for the whole space economy. Every single public space company will be judged against those baseline numbers. That is exactly why we've got to run our analysis today before the market fully digests this massive paradigm shift.
For this report, we've zeroed in on 3 specific targets: Intuitive Machines, Rocket Lab, and AST Space Mobile. As your lead analyst, I've got to stress that this evaluation is derived strictly from the available company filings, analyst notes, and financial news reports. We are combining qualitative business assessment with hard, cold data.
Section 2. Business and moat comparison, Buffett style.
Warren Buffett teaches us to always look for an economic moat. But in the vacuum of space, a durable competitive advantage isn't, a beloved consumer brand like Coca-Cola. It's proprietary orbital infrastructure. It's deep, sticky, exclusive government contracts. It's in-house capabilities that competitors literally cannot replicate without billions of dollars and years of research. We need businesses whose long-term prospects ensure they're still going to be thriving and generating predictable earnings in 10 to 20 years.
And this right here brilliantly illustrates a tangible, physical moat. This is Intuitive Machines' Nova D lunar lander. Intuitive Machines builds actual lunar infrastructure and runs NASA's near-space network. Their moat is incredibly wide, supported by a staggering $4.82 billion in NASA contracts. They just secured another $180.4 million Commercial Lunar Payload Services Award to deliver payloads to the lunar South Pole. In a highly speculative industry, deep integration with NASA's Artemis program provides some truly exceptional industry stability.
Now, contrasting that, Rocket Lab also has a formidable moat, blending narrow and wide characteristics. They build launch vehicles and spacecraft completely in-house, making them the closest public comparison to SpaceX we have. Their moat is verified by a massive $2.2 billion backlog. Then we have AST Space Mobile. They're building a direct-to-cell satellite network anchored by massive telecom partners like AT&T and Verizon. Actually, scratch that. Their moat is currently very high risk. The recent failure of their Bluebird 7 satellite puts their aggressive 45-satellite year-end target in serious jeopardy. From a Buffett's perspective, the earnings predictability here is highly questionable.
So, summarizing our Buffett checklist, are these businesses understandable? Yes. Do they have durable competitive advantages? Intuitive Machines certainly does. What about able and honest management? Well, capital allocation and insider ownership are our best indicators here. Intuitive Machines shows exceptional management alignment. Our data shows insiders, like the executive chairman and CEO, hold over 73 million of the roughly 117 million outstanding shares. When insiders hold that much equity, their long-term interests are totally locked in with the shareholders. Rocket Lab also shows strong management through strategic acquisitions like Motive Space Systems. ASTS, on the other hand, remains highly speculative.
Section 3. Deep financial data comparison.
Now, what's really interesting here is this staggering single number. $2.2 billion. That's Rocket Lab's current backlog, which more than doubled year over year. They just posted record Q1 revenue of $136.7 million, beating estimates. This signifies massive surging demand, particularly fueled by Pentagon projects and NASA's Artemis missions. It's absolute proof that their in-house launch capability is converting directly into contracted future revenue.
Looking at Intuitive Machines, we see a company in a vital financial transition. They hold $622 million in cash against $371 million in debt, providing robust runway for a really capital-intensive business. Their net loss shrunk dramatically down to $10.3 million in Q3 of 2025. But the real standout? They are guiding for $900 million to $1 billion in revenue by 2026. They are the only listed pure-play stock in this group, guiding to positive adjusted EBITDA in 2026. They're projecting actual profitability, which is just a huge differentiator.
Now, committee, look closely at this comparison table. To run a textbook discounted cash flow or Graham's intrinsic value formula, I need 5 to 10 years of historical free cash flow, return on invested capital, and consistent EPS data. Because we are relying strictly on the provided documents for this young sector, that long-term historical data simply doesn't exist yet. As intellectually honest value investors, we've got to acknowledge this limitation. We are forced to value these companies based on forward-looking management guidance and recent quarterly momentum, which inherently increases our risk. Bottom line, if we want perfectly predictable historical cash flows, we really shouldn't be looking in space just yet.
Section 4. Valuation and safety margin.
So, the crucial point is how conflicting the current valuation signals are right now. Take Intuitive Machines. Our data shows a current PE ratio of 7.8 times, which sounds incredibly cheap for a high-growth tech stock, right? But look right next to it. The price-to-sales ratio is sitting at a massive 20.1 times. This crazy discrepancy happens in early-stage companies where revenue hasn't scaled up to match the market capitalization yet, despite some positive earnings blips.
Because we lack the historical data to build a reliable proprietary DCF model from scratch, we have to stress test Wall Street's intrinsic value estimates. For Intuitive Machines, the low target is $11, the average is $24, and the highest optimistic target is $35. And the stock? It's currently trading around $28.97.
And here is our valuation reality check. A core tenet of our philosophy is buying at a 25 to 30% margin of safety below base intrinsic value. With Intuitive Machines trading at almost $29 against an average target of $24, that margin of safety is entirely non-existent. Rocket Lab is in a similar boat. Despite incredible fundamentals, the stock recently saw a massive 240% year-over-year run, pushing prices to levels where the market is basically already priced in years of flawless execution. You're paying a premium purely for future growth potential.
Section 5. Final Value Investor Verdict.
The classic Buffett question we have to answer today: are these wonderful businesses at sensible prices? Based on our strict criteria, here is the final ranking. Intuitive Machines is financially the strongest, with the highest quality earnings potential and the widest moat, thanks to deep NASA integration and massive insider alignment. However, at current prices, it's overvalued. It is a hold. Rocket Lab has a spectacular business model and a phenomenal $2.2 billion backlog, making it a wonderful business. But the recent price surge completely eliminates our required margin of safety, so it's also a hold. AST Space Mobile simply carries way too much operational risk with the failure of Bluebird 7. It doesn't meet our business quality standards. It's a firm pass.
Ultimately, committee, we are witnessing the birth of a totally new industrial era. As one of our sources aptly noted, the future of the space economy hinges on execution rather than merely achieving access to space. The businesses are wonderful, the engineering is absolutely breathtaking, but right now, the prices demand perfection. As value investors, we wait for the market to misprice these execution risks before we buy. But tell me, when that massive SpaceX IPO drops and resets the entire market's expectations, will you be ready to calculate the new intrinsic value of the final frontier?